All right, good morning, everyone. I'm Michael Valera, CEO of Plato Partnership. I wanted to thank all of you today for joining our webinar on what I believe is one of the most critical issues facing our industry right now, the rising cost of equity market data. Before we begin, I wanted to extend my sincere thank you to Nikki Beattie, her incredible team over at Market Structure Partners. Nikki, just wanted to mention that the depth and breadth of this research is truly remarkable. Nobody has ever attempted to cover the topic of market data quite so comprehensively. And your team's dedication to working through thousands of lines of public disclosures has given us an unprecedented insight into this important issue. I also wanted to thank the Consortium of Trade Associations and their communities who made this research report possible. Our partners at AFME, BVI, EFAMR, FIA, EPTA have been instrumental in bringing this research to fruition. Your support and collaboration have been invaluable to these efforts. For those of you wondering how this research came about, at Plato Partnership, we work entirely by committee. Our advisory committee votes on potential topics of interest. We then commission independent research into these areas. This particular research was commissioned in direct response raised by concerns from our members, a consortium of both buy and sell side members. I also wanted to stress here, as with every research report commissioned by Plato, it was conducted with complete independence. Plato members suggest the topics only, and we have zero influence over the outcomes. Let me walk you quickly through today's agenda. Nikki will walk us through the report and its key findings. This will be followed by a Q&A session. There's been a huge amount of discussion in the marketplace since this report was published. So we wanted to give the marketplace and the attendees the opportunity to ask questions and get some clarification if needed. We're then going to move to a panel discussion. We have representatives from Walt Kernel, Sigma AI, BCC Group. We've invited these entrepreneurs from the market data space to provide their perspectives, both on the topic and on the report. Some quick housekeeping. You can submit questions through the Q&A button on your screen. These questions will be directed to Jack Bender, who's the head of marketing communications at Plato. If you have any technical issues, feel free to email Jack directly in the event that your Q&A platform is not working for you. His email has been included in all the event communications. You'll also find on the page resources button. This is where you can download the full report, research report, as well as the executive summary. And we will also, just so you know, be uploading this video to the Plato website immediately after today's event, as well as sharing the video with everyone that signed up for the event after today's performance. So I wanted to thank you again, everybody, for joining today. This research highlights the issues that affect every single one of us in the industry. I'm genuinely grateful for your engagement on this important topic. So without further ado, let me hand over to Nikki to take us through her findings. Thank you.
Thank you, Mike. As everybody said, or as Mike said, I'm Nikki Beattie, CEO of Market Structure Partners, and I'm going to walk you through a summary of the results of the study that we did, and then we've got a panel and Q&A as well. So I'll get started straight away. So hopefully everybody can see the presentation. And so this is all about European market data. I'm going to just run through. I know there's quite a few people that are on the line from overseas who are not necessarily in Europe. So I'm going to quickly run you through the legal basics that form the background to this whole discussion. And that was that European regulation, MiFID I, came into effect in 2007. It was later updated and new regulations, updated regulations came into effect in 2018. But effectively, there were two things that were introduced in 2007. The first was competition in trading, which allowed new trading venues known as multilateral trading facilities or other new exchanges to compete for secondary market trading. And the second part of that was the concept that a market data should be made available on a reasonable commercial basis. Now, the law did not explain what aspects of market data should be commercially separate from everyday trading activity. It does mention that it requires prices to be based on a reasonable relationship to the cost of producing and disseminating that data. It did not define reasonable, and actually it seems to assume that exchanges are responsible for disseminating data, and we're going to see in this presentation that in fact they are not. And it also said that providers should determine their fees on the basis of their cost of production. Just to give you some quick background, Mike just introduced the sponsors of this study, so I don't think I need to introduce them any further other than to say they represent both buy and sell side organizations. The study was on European equity market data. We didn't look at the cost of index data coming from the exchanges, and we looked mainly at these 5 exchanges listed here: Deutsche Börse, Euronext, the London Stock Exchange, Nasdaq, Nordics, and SIX. We reviewed their annual accounts since MiFID I started, so from 2008 onwards, and we reviewed their fee schedules and contracts mostly from 2017 onwards. And to be honest, it's such a complex subject that we didn't get to look at all of them in detail, and we focused most of our time on Deutsche Börse, Euronext, and LSEG because that was where the sponsors said they had experienced the most difficulties. And if I remind you of previous studies, there was one done by Copenhagen Economics published in 2018, which had found that the cost of equity market data had increased in the range of 30 to 60% over the previous decade, and that there'd been a doubling of fee categories. And we're going to talk about fee categories a bit later. And this was despite the cost of the underlying technology having fallen. And then Oxera have done a number of reports for the Federation of European Stock Exchanges. The dates are all there, and more recently for the London Stock Exchange. And they've very much focused on demonstrating the rationale for the current cost of market data and providing general observations on the exchange's role in market structure and price formation, the cost of production, and the economies of scale required to run an exchange. I'd just like to also actually thank my team, Yoni and Cassel. I think they're both on this call for their untiring work. I think Yoni will attest that looking at market data schedules makes a grown man cry. It's been a lot of hard work over the last year to do this work. So just a reminder, what is market data and why do we need it? I think everybody on this call knows that pre-trade and post-trade data are what makes up market data. I don't think that needs any more introduction, but it is a mutual tool for growth for all market stakeholders. It's very critical for everybody. It matters for issuers and investors because it gives them confidence in their valuations and their investment decisions. It matters for intermediaries because they're trying to optimize outcomes for those issuers and investors. For policymakers, particularly now looking for growth and innovation to enhance competitiveness, then it's very important to create that growth and also to maintain market trust and resilience. And for exchanges, it should be about advertising their liquidity, but increasingly it's becoming a source of revenue. And we've estimated in our report that since 2008, these exchanges have earned £5.67 billion or 6.7 billion euros from equity market data alone. So I just want to talk about cost of production and give you an analogy so that it hopefully becomes a bit clearer what we're going to be talking about in this presentation. And forgive me those who read my LinkedIn article last week because I'm going back to this. But I want everybody to imagine that they just got home with a takeaway meal. You're sitting on the sofa about to eat and the restaurant rings you and they say, by the way, you owe us some extra money. And you say, well, what for? And they say, well, actually, we're going to charge you for how many plates or bowls that you use when you're eating. We need to know whether you've reheated it in the microwave or in the oven. We actually need to know what you do for a living because that adds an extra fee. We need to know how many friends and family shared the meal with you. Now, in normal circumstances, you'd say, well, it's none of your business. I pay for these things and not you. But in this particular town that you live in, you don't have a kitchen at home. There are not many restaurants to choose from. And so in order to get some nutrition every day, you need to be able to take something away from this takeaway. So the restaurant's fees continue to proliferate. They start asking you whether you're using a knife, fork, spoon, or chopsticks to eat with, what time of day you're eating, and whether you keep any food in the fridge. They then say they reserve the right to come in to look in your house and check on what you're doing, and you can't do anything with the food that isn't pre-agreed in the contracts with them. Now, this may seem completely absurd, but this is what the world of market data has become. So I want to talk about the cost of production in the market today. So let's have a quick overview of trading platforms and their costs. So exchanges have to run a trading platform. They have software and hardware costs. They have costs of data centers, cybersecurity spending, and cost of power. In theory, they recoup this in a trading fee. They produce a finite amount of trading data every day. There would be no trading without this, no trading business without this data being produced. And actually, whoever consumes this data, whether there's 10 consumers or 100, it costs the exchanges nothing extra in order to generate that data. Now, the exchanges also have a connectivity layer. This is the door, effectively, where you're waiting to get your food, in my analogy, where they take the data out and produce, or people come and take the data out. There's actually very few people connected to the exchange, probably hundreds, not thousands, directly connected to this layer. And then those people take the data and disseminate it throughout the market. Exchanges also charge a connectivity fee for this. That's their commercial decision as to whether they do so, but they are getting extra revenues from connectivity. And then finally, we've got the whole world of dissemination, which is actually where market participants bear the costs. They are the ones that take the orders, or take the data and farm it out into the entire market. They are the ones that invest in all of the costs of disseminating data across the market and getting it to the end investors. So why does all of this matter? Well, originally, when we had exchanges that were running 100% of the market, they were responsible for the whole market. They were nurturing that whole market, and they could choose how they recovered costs, whether it's through trading or data, it didn't really matter. But in theory, well, in reality, actually, the exchanges charged a very modest fee when they were in this position, and they still do in other markets, if you look at that, and we've given some in our report, some examples in our report. At the other end of the spectrum, what you see is new trading venues who can't sell data because actually they haven't got very much to sell. They're obliged to give data away to attract business, and they can only recover their costs from trading venues. Then you get into this next phase where people are growing trading venues, and they may be able to sell their data, but everybody doesn't have to buy it if they don't want to. If they can sell the data, then the revenue can be offset against the costs as a separate business, but it will have to price that data according to competitive tension. So we call that a price taker, and they can't really do things that exceed their own costs of production. And then we get into what I call this problem area, which is where you get exchanges that have lost market share, but are still the most important market, probably in terms of market share. And so people have to buy their data, and it's very important to understand that in European regulation, actually, people are enforced to buy this data in order to do certain jobs. What happens here is the exchange moves to defend its position as it starts to lose market share. But it's still in this very fortunate position where it has to, or where people have to buy its data or consume its data. But the exchange starts to shift its focus to growing data revenue, potentially at the expense of growing trading revenues. And to be honest, we have to say it may be advantageous at this point for this exchange if participants can't see other trading venues' data. So this exchange is no longer in a position where it's nurturing an entire market and is more inclined to be nurturing its own. So in theory, when market share declined, what we should have actually seen is a decline in the exchange's total revenue since 2007 when competition started. And to be very clear, total revenue equals the revenue generated from equity trading plus the revenue generated from equity data. And what we saw was competition in trading actually meant that exchanges lost on average, this is an average of all of the exchanges we've studied, they're down to about 50% of their home market compared with where they were when they started. They've got a less valuable and less comprehensive data set than they had because they no longer have 100% of the market. And actually, they've got less activity than they used to have, or certainly less data of the same or more limited data accompanied by a downturn in volume. So in theory, we would have seen trading revenues go down as a result of that, or total revenue should have gone down, including market data. The other thing that's happened is after the financial crisis and also with ongoing consolidation and automation of jobs, there are now fewer organizations and fewer people viewing data on terminals, and there are more machines consuming data. And we've just given down here a number of the organizations, just to give an idea, that have disappeared or been merged, with different trading activities merging into two different organizations, that have reduced the number of people that are overall looking at data. But that didn't happen. What we didn't see was really the decline that we expected. Data revenue has actually been offsetting potential decline. So that means basically, while trading volumes have decreased, trading revenue has declined, but market data revenue is in fact increasing. And the proportion that market data contributed to overall revenue has also increased. Now, exchanges have to make public disclosures and on their market data revenues and their market data revenue percentages as a percentage of the total revenues that they're earning from both trading and market data. And this is Deutsche Börse. So what we can see here is in 2020, Deutsche Börse, the proportion of revenue that Deutsche Börse market data contributed to total revenue was at 21%. But what we've actually seen is that has grown by 2023 up to 31%. And what you see down the bottom here is the revenues have gone from 59 million euros to 78 million euros. So we're seeing an increase despite the fact that volumes, which are being shown here, are going down and equity market revenues overall are going down. So what we're seeing is the increased amount of money that is being made in market data despite this happening. Now, the interesting thing is if you contrast this with Eurex, Deutsche Börse's derivatives exchange, Eurex's market data revenue percentage has remained at around 6.8% for the same period. It hasn't changed at all. And this is a market where they own 100% of the market and obviously very keen to nurture that whole market. Then what we have here is Euronext declaration. They've also been making those declarations. And what we see here is the Euronext figure starting at 11%, its market data revenue percentage, going up to 19% in 2023. Now, I just want to point out here that Euronext has made it known that actually the data that they used in 2020 was in fact different to the data that they used in 2021, 2022, and 2023. In 2020, they quoted a figure that came from using their entire group revenues rather than their overall equity revenues. This figure, therefore, of 11% may be smaller than it should have been. It could be at around 13 or 14%. We don't really know unless it gets restated. So we've got some lessons in here for regulators. If this data is inconsistent and can't be measured over a period of time, then that's a problem. So we think it would be very good if these exchanges were asked to restate figures where these sorts of things had occurred. We also think it would be really useful if regulators made sure that exchanges told them if they changed any of their disclosures. So what you can see here at the end, I've said the market data revenue percentage has gone up to 19%. And what we've seen is the revenue's gone from 100 million euros up to 166 million euros, despite the revenues overall declining and the volumes overall declining. So we've been criticized by Turquoise for saying not having LSE figures in there. And we made a statement in the report saying that LSE did not have to make reasonable commercial basis disclosures, and we'd use Turquoise data instead. We actually agree that statement is incorrect. The LSE does in fact make disclosures, and we're going to replace the Turquoise disclosures with the LSE ones given here. The main reason we said we thought they didn't is we couldn't find any disclosures beyond 2021, and we thought they had stopped making them post-Brexit. However, we've been pointed to those disclosures, and we've also seen that a new one has been added more recently. And so a couple more lessons for regulators here is it would be really helpful if ESMA and the FCA kept a repository of all these disclosures in one place so they can easily be found. We also don't know why exchanges publish their disclosures 2 years in arrears. They should be published as soon as the exchange's annual accounts are published. So what we can see here, the same story again. What we're seeing is a market data revenue percentage starting at 13% and going up to 16%. and revenue figures, market data revenues going from 67 to 79. Now, we can't actually reconcile these figures with the London Stock Exchange accounts. So another lesson, I think, for regulators to take away is it would be really good if disclosures actually told us where we would find all this information and how we could reconcile this to their accounts. As an aside, the figures we quoted for Turquoise were directly from the disclosures for the Turquoise Global Holdings entities, which showed that volumes for that entity had gone down and market data revenues had gone up. However, Turquoise does have a second entity called Turquoise Global Holdings Europe, where the majority of its business is currently done, and we did not report on the disclosures for that entity. Finally, we've got Nasdaq Nordics here. Again, you can see a similar trajectory from 19% up to 23% for the market data revenues, and the revenues have gone up from 55 million to 59 million here. We acknowledge in both Euronext and Nasdaq's figures that there is a small proportion of fixed income. So a final lesson for regulators is it would be really helpful to make sure that these disclosures were clearly set out by asset class. Nonetheless, that is a summary. Everything is going in a similar direction. There's a clear trend at all exchanges regardless. And this is really counterintuitive if we think about the fact that their market share has gone down, and it suggests that there is not competitive tension in the market. What we've seen, so how have they achieved all of those increases? Well, what we've seen is they've introduced more cumulative fee categories. So this is an example from Deutsche Börse's fee schedule. This is how it's grown for use of the same data from 2015. They had 20 pages in their contracts and fee schedules. Now they have 52 pages. Seen something similar at the other exchanges. Euronext went from 19 to 46 pages, and the London Stock Exchange more than doubled its fee categories. And arguably, we would say that none of the fees in all of these pages are connected to the exchange's own cost of production. They are all connected to the customer's cost of production. What do we mean by this? Well, let's go through some examples. First of all, we've seen a differentiation between fees for display data, where a human being looks at a terminal, versus non-display. Now, there is no change in the exchange's costs of production, regardless of whether somebody is looking at a terminal with a pair of eyes versus a machine looking at it. And yet the exchanges have created a premium fee for non-display data. And if we look at what actually happened at the LSE here, this is figures taken from the London Stock Exchange accounts to their shareholders, their public audited accounts. What we see is that their terminal numbers for people who were looking visually at data were in decline from 2006 to 2020. We don't have data after that because it's no longer so transparent. And if you read the accounts, London Stock Exchange was telling its shareholders that the market data revenues were in decline along with that. But then what happened around 2016 is the accounts say, but we've got this new set of fees. It's called non-display fees. And we've managed to recover, and actually we're doing very well. And this figure here that I'm following with my cursor is or the line is the trajectory of the real-time market data fees once the non-display fees had been established. So we can see that, and we can see how it's been very healthy for profits as a result. The second thing that exchanges have done is they've tiered customers. So they have display and non-display, and then within that, they have different things. So within display, they have professional and non-professional fees. Non-professional fees are generally for a typical retail customer. However, if you are somebody who has worked in finance before, even if you're managing your own pension, or even if you're a rich person who's run an ice cream business and you've got lots of money, you get charged a professional fee rather than a non-professional. This is completely arbitrary and a subjective fee for exchanges. Then they have non-display fees, and that's very complicated. That is divided up between things like whether or not you run a competing trading platform, in which case you pay one sort of fee. If you trade as principal, you have another sort of fee. And if you have trading as a brokerage, or you trade as a principal and a brokerage, then you pay different fees again. And then finally, if you don't do any of those other things, but you want to create an index, then you must also pay a fee for that as well. And this is what makes all the fees so variable. And it means there's no one cost for any single organization. regardless of this, there is no difference to the exchange's cost of production as to what all of these people are doing with the data. There are other random fees, for example, how many devices might have access to the data. If I want to look at it at my iPhone, my laptop, and also a terminal, then I have to pay different fees for that, despite the fact that I'm the one that produces and pays for the iPod, the iPad, the iPhone, and whatever other device is looking at it. You might have to pay for what time of day the data is used. No matter what these things are, there is no change to the exchange's cost of production. And then finally, they've got these creative works or derived data licenses, and there's numerous conditions attached to each cost. There's certain clauses that prevent customers from doing anything, irrespective of the fact that the customer is making all the investment to capitalize on the idea. And it's making it very hard for innovators to use the data in new ways, because there's financial risk that they just don't know. They can't determine how much that financial risk is, because they don't know exactly what the answers are to all of these questions the exchange might be asking. There's also redistribution fees that have been applied with diminishing generosity, that's resulted in increasingly onerous restrictions and charges. The more people I want to disseminate data to now, despite the fact that I might be bearing the cost of that and not the exchange, the more I have to pay. And this is counterintuitive again, because actually it should be desirable for data to be as widely distributed as possible, and the exchanges really should be quite thankful that the fact that somebody else is bearing all the costs to do that. So taking all of these things into account, we looked at certain elements of what have been happening in the markets, and we said, in one example, we've said, well, what happens to what a human used to do in 2017 if we look at all those activities versus what a machine might be able to do in 2024. And what we found is, for example, that actually at Deutsche Börse, it's now 34 times more expensive for a machine to do what a human used to be able to do in 2017, 84 times more expensive at Euronext, 96 times more for a member of the LSEG, and if you're a non-member, it's 76 times more. So you can see there how the premium has been applied. Now, we've applied certain conditions to this. Again, there are multiple variable conditions you could use to look at this. So we've then looked at the results of what happens if you tier customers, and we've looked at just taking non-display data. So this is our view of a single product, and we've said, how has that product changed in price over the period of time that we've been looking at since 2017. And what we saw here is actually that competing trading venues had experienced at Deutsche Börse a 481% increase in price. Now, inflation was about 24% during this whole period, and here we're seeing a 481% increase. Again, there's different conditions. If you want to be creating an index license at the same time, then you've experienced a 225% increase. And what we should say here is actually, I know that LSE and Euronext look better than Deutsche Börse, and it paints Deutsche Börse in a particularly bad light. But actually, if we had cut this data at a different point, for example, in 2014 or 2015, then Euronext and LSE would have looked quite similar, and Deutsche Börse would have looked different, because it was the last one to introduce non-display fees. Equally, if we look down here, this is where this is where firms who are not operating as a trading platform or as brokers, but who want to create indices, they've seen fairly astonishing increases in prices as well, 97% at Deutsche Börse, 170% at Euronext, and 46% at LSE. But in reality, everybody is not just taking non-display data or a single product. They're taking multiple different sets of data. And we made a hypothetical retail broker speaking to several real retail brokers to ask them about their business. And they would be taking display data, which they would be sending through to their end clients, as well as using internally, perhaps for compliance. They would be looking at non-display data as well, and they would be having to keep on top of all of these different fees. And we said, what's been the experience of this sort of retail broker? And what we've seen is, obviously, for display data, there's been fairly significant increases at Euronext and at LSE and Deutsche Börse. They've been under inflation. In fact, Deutsche Börse has reduced display non-professional fees quite considerably. But others have got rises of 75%, 151%. And again, we've got the non-display rises that you've already seen before. So we didn't find any rational explanation. We went to ask ourselves, why is it possible that these fee rises are happening? And we looked at things like cost of production. So although we think that all of the exchanges' cost of production are related to running a trading platform, we still had a look at them. We don't think they've got any specific costs for producing or disseminating data, but they do have costs for running the trading platform. But we found most of those costs are either declining or only rising in line with inflation. So that's things like software, hardware, etc. Exchanges have run the same trading software for more than a decade, for example. Data center costs are going down. Cyber security costs, yes, they're going up, but not that significantly. And exchanges have done significant strategic partnerships with some of the big cloud providers. So we didn't find any rationale there. We said the cost of providing low latency connectivity has not gone up specifically, and if it has, then it's being paid for through a separate connectivity fee, so it shouldn't be bundled with the rest of the costs. There's no particular evidence of investment in the exchange's accounts of any significant expenditure of this sort of size, and as I said, they've run the same technology for more than a decade, and we don't find that there are any greater economies of scale in the what the exchanges are doing. And I'll talk you through that here. So, for example, here what you see is an MTF like Cboe Europe, which is running fairly significant volumes. In fact, it's running far greater volumes than Deutsche Börse and certainly than Euronext was, although Euronext has now increased with Borsa Italiana. And also London Stock Exchange is running slightly more than Cboe, but Nasdaq, Nordics and SIX are running well below it. So there is no rationale to say that the exchanges have greater economies of scale. And therefore, what we said is actually, if it was based on market share, then exchanges would have been making 44 million per annum, these exchanges jointly, but instead they've been making 338 million per annum. So 7.64 times more than an organization like Cboe, which is running very similar volumes. So what we're saying is exchanges could have generated up to 4.93 billion in surplus revenues in pounds and 5.83 billion euros since 2008, because really they're being able to charge for their customers' cost of production, reaching well beyond their own cost of production. I said there was no evidence in the exchange accounts of this. What we've seen is a 57% increase at Deutsche Börse, which is above inflation. But if you read the accounts, it's mainly related to expansion into other asset classes like commodities and FX. At Euronext, there has been a significant increase in expenditure, but this is down to the operational cost for absorbing Borsa Italiana. The LSE has seen a significant reduction in costs, which doesn't appear to have been passed on to any of its equity customers. And SIX has seen costs rising broadly in line or just above inflation at 32%. But these are just the top of the iceberg numbers, because in fact, there's a lot of intangible costs to the market, which include the reduction in innovation because market data is just not easily accessible. What we're seeing is efficiencies are not being passed on to the market. We saw LSE's costs have gone down, but it's not clear that those have been passed on. And at the same time, market participants are unable to capitalize on investments in automation. We've seen restricted dissemination of data and obfuscation of the total market liquidity as a result of the current contracts. And we've seen reduced motivation for the exchanges to grow the total market because they can simply rely on increasing market data revenues to offset overall income decline, and they may not be reinvesting in equity markets. And effectively, there's no longer a mutual objective to grow the market. Exchanges may wish to reinvest their profits to grow other non-equity businesses rather than invest in their equity businesses. And this is resulting in higher than necessary costs for other competitors as well, who may be more willing to invest in equity markets. And what we've seen is the role of equities is diminishing at exchanges. At Deutsche Börse, this is in 2017, it was at 5%. That was the contribution that equities made to their overall revenues. It's now down at 3%. A similar story at the London Stock Exchange, went from 13% in 2017 to equities now only contributes to 3%. So really what we're saying is the reach of exchanges is far beyond their own cost of production. What we believe is all of these fees like display, non-display, number of devices, cost of distribution, etc., is not required. And actually the definition of reasonable is really hidden in plain sight, because reasonable is actually not charging for all of these things that are the customer's cost of production and not the exchanges. So effectively, we think there's a very easy answer for the definition of reasonable. It's take out all of these costs that are not related to the exchange's cost of production, and that charging should stop at the perimeter of the organization that the exchange is connected to. And what those people then do with the data is up to them. So conclusions and recommendations, we're basically saying there isn't a market in market data, and it doesn't make sense to assume there should be. There is no competitive tension out there in the market. It's resulting, and this lack of competitive attention is resulting in excessive prices and restrictive provisions that are completely unnecessary and have become a hindrance to the growth of the market. These fees, as I said, bear no relation to the exchange's own cost of production, and they're much more related to the customer's cost of production. And the growth of equity markets seems to be becoming relegated to a secondary objective. It's easier to make money from data than it is from trading, so why bother with the trading? Now, we're not saying trading venues shouldn't be free to diversify, but regulatory reform is necessary to ensure that all license holders meet concomitant expectations to support the key objective of growing the market. We recommend that legislators should oblige trading venues to treat data as a byproduct of the trading process it underpins, and that basically means ensuring no charges related to the customer's cost of production. And finally, we're saying policymakers and regulators must step up to safeguard markets and prevent behaviours that impede growth, so that we can have more clearly defined objectives for trading venues. So thank you very much for listening to that. Jack, what we might do is take a couple of questions and then we'll move to our panel.
Yeah, I mean, we have got a hell of a lot of questions as anticipated, Nikki. I'll start with a more practical question, which was about specifically slide 22,
Yes.
which apparently was a little bit confusing to this delegate. They said that, are you saying the exchanges did not gouge as much as they could have?
Crikey. I mean, that's a question that is hard to answer. I mean, you know, I think that there's significant, I mean, gouging is strong language, so that's the first thing. But I think this is continuing, this issue. What we're seeing this year, for example, 2025 has got new prices for use of artificial intelligence. Clearly, that's got nothing to do with the exchange's cost of production. So what we're seeing is this constant creep, which means that more and more could be made in market data. So effectively, is there scope, if this carries on, is there scope to make more from the exchanges? Yes, absolutely. I hope that answers the question in the right way. So thank you. Anything else?
A lot. I think we might have to do an email out to everyone answering some of these.
Okay. Should we move to the panel first of all then? Because we've got some very kind people who've been waiting for us to be in this panel. So what we've heard from the outset or of criticism of this is that this is lobby groups against each other and not really not really about the end consumer. And so I've invited three entrepreneurs to be part of a session where we just talk about what it's like to be an entrepreneur trying to, thank you, everybody's here, trying to deal with market data in the industry. So I might introduce my panelists. Actually, what I might do is get my panelists to introduce themselves. So all entrepreneurs, I'd like each of you perhaps to introduce yourself and just make a statement. I'll start with Bill. Make a statement about your business and why it's improving equity markets.
Yes, so my name is Bill Beards. I'm president of a company called BCC Group based out of Frankfurt, Germany. I am living in New York City. So BCC Group is focused on helping data consumers to introduce competition into the market. We feel as though a lot of the things that Nikki is talking about could be addressed by introducing some competition and giving customers the ability to get access to data sets from various different data sources, right? So that's what we're in the focused on doing. But we do hear everything you're saying, Nikki. We hear everything from our clients. It comes down to price increases, contractual complexities, increased entitlement requirements, and all kinds of things, and audits on top of all that, which you didn't mention, right? So so there's definitely some stress in the market from what we're hearing from our clients, and I think this is a very valid point, very valid topic.
Thanks. Karen, would you like to introduce yourself?
Yep. Good morning, everyone. My name is Karan Shamagaraja. I'm the CEO of Wealth Kernel. Unlike the others, I should have put the name of the company in the title. One for next time. So we're effectively an API. We're an API-based broker custodian based in the UK and expanding. Well, we've just are in the process of picking up. We're just obtained our European license for brokerage and custody in Spain as well. We power a lot of fintechs who use our API connectivity to provide savings investment services to predominantly retail customers. So if you've used an app and there's an embedded investing service, we would provide the infrastructure layer to that. I will say, Nikki, you've done such a great job. I'm actually happy to yield some of my time to you just to hear some of the answers you might give to those questions. Because I feel like people on the call might get more value hearing from you than me. But
we'll come back to it at the end of the call, maybe, Nikki. That might be the easiest way to do it.
Yeah. Andy, would you like to introduce yourself?
Thanks, Nikki. Yeah, thanks very much to Plato and to Market Structure Partners. An illuminating overview, Nikki. Sigma is a real-time market analytics, research and analytics firm predicated on the use of AI to provide insights to market participants. And what we aim to do is provide natural language output that's timely. So as it happens, event production rather than producing reports that take hours or even days sometimes to actually craft. And so data is phenomenally important to us, and the understanding of where we get that data from, how accurate the data is, and what we can do with that data ultimately, whether it's for derived use and onward redistribution, etc., is phenomenally important. We also use private data, actually, and I have to say, we've found using private data far easier than getting public data into our system, just for all the reasons you've mentioned. And what's fascinating to us is that we reckon that looking at the projections for the business, probably 50% of our IT costs will be data. And we've spent a lot of money on building a real-time streaming AI engine, and you'd think that that would be where all of the money should be spent on that innovation. But in actual fact, we find that the projections are going to be that more than 50% probably of our IT costs will be on the consumption of data. And as I said in the post on your system, to us, it's a wild west of different formats, protocols, contracts. We're 3 years old, and I have to say, in the 3 years, we've spent a huge amount of time researching data, and nearly failed because of data. Nearly failed.
Wow. Okay. And none of you are regulated companies, are you?
No.
Okay. So you're all there.
No, we're highly regulated.
Sorry, Karan, you are?
We're very highly regulated.
Yeah.
Okay, apologies.
Adding to Andy's comment as well, I think that our clients want to have access to new sources of data as well.
Yeah.
You know, that the market is expanding every day, and a new data source is created. And if the complexity keeps growing and keeps getting more difficult for entrepreneurs to be able to, and also large institutions to be able to get access to these data sets, it's stifling the market's ability to grow and to really grow in the right way, like in the AI space, for instance, right? So we need to make this easier, not more difficult, I think. So
that's right. I'll just add to Bill's points about our system is data agnostic. Actually, we built it to not really care whether, not just whether it's asset class agnostic, whether it's an equity, a future, or whatever. Whether it's FX, whether it's commodities, our system shouldn't matter. And the trick that we've found is the way that exchanges have started to also, some exchanges started to not just sell their own data, but then add on top of that what they would call consolidated or aggregated feeds. And that's even more complicated. So you get the feed, the aggregated feed, and again, won't name names, £10,000 a month for the aggregated feed. look at the contract, which is 18 months long with a 6-month notice period, try to get test data to sample that, because it's a lot of money to us, £10,000 a month, then to find in actual fact it's not just £10,000 a month, that's the aggregated feed. On top of that, I have to then go and sign a contract with every of the exchanges I need to have into that aggregated feed, and each one of those then I have to pay for separately on top. So the consolidated aggregated feed concept is just a broker, if you like, to provide me with the feed, not the actual data itself, which I've then got to pay for on top. So it is a complete and utter minefield, and it takes a lot of time for us. I mean, really, time is of the essence as a small business with limited runway, to have to step through all of those contracts to find out exactly what we need. And we've found that actually going to some of the firms that are more like ourselves in terms of style and culture, in terms of nimbleness and aggressiveness with costs and things like that, the aggregated feed providers like Polygon and Alpha Vantage and Marketo and so on, Barchart, they're at a much better place for us to find data than it is to go direct to the exchanges.
So Karan and Andy, you both spoke to me about the long email chains and the sort of pain of trying to get data. Karan, I don't know if you want to comment on that.
Yeah, it's I'd say irony is price discovery with data providers in itself is a challenge. I think there's, I'm trying to be balanced about this. Like, clearly, like the sales staff or the people that work at the exchanges are motivated on some type of structure that tilts them towards large companies because there's more revenue to be extracted, and there's no sense of urgency when you're dealing with them. They have no fear of competition. They know it's a monopoly or quasi, and they effectively spend the bulk of their time to figure out. And this is the thing. There's obviously an information disadvantage to someone like myself who's not as experienced dealing with this. I liked how you laid it out, because now I can see, looking back to the history of those comms that we had over 6 months to get to our first pricing number, I think they were trying to figure out, like, where can we classify them without it be the maximum amount of value to charge them without giving a single rate card. You always ask questions about, like, how many customers you're going to have, like, in 2-3 years. We're a startup, who knows? Like, you're always trying to understand, like, how you can use it. And because we're an API company, I can see in there where it's pretty binary. You're a machine or a human. It's not so binary, Like, you can argue that before every human reads a terminal, it might go through internal machines, and it gets quite messy. And that process just takes you cannot just get a rate card. You can't be like, can you give me a rate card, whether I have one customer or 1 million retail customers, and just give me like a chart of all the things that you have. But it's not like that. You feel that the rep is constantly trying to optimize for whatever personal sales goal they're doing or to the firm's benefit. And you're completely kind of worried that you might say something that's going to, like, weaponize how they can like potentially, like, use a legal agreement against you because you said something. You can't just be open. And what always struck me is, like, the lack of urgency on their side. It's just like, like, all roads lead back to us. This is your regulated business. And that's just, like, it's an incredible way. It's an incredible business. Like, from the buy side perspective, it's great to invest in it. But it's, as the other gentleman said, that time is just killer. Like, sorry, Andy. We tend to operate in days and weeks here. Like, why does it take 6 months to get a rate card? Like, why can't you just send us your rate card across the board? Why can't I just say, can you send me all your prices for all your things? Let me read it and come back to you. No, that's just not an option. That is not an option, which is ridiculous.
Bill, similar experiences at your end? Which I should say, you're in the US, kindly, very early in the morning for us this morning. But the business in Europe as well.
Yeah, my company's based in Frankfurt, and many of our clients are in Frankfurt. We've been at this for 7 or 8 years now. We've been hearing the data consumers talk about this topic, so I think, and when you talk to the exchanges and you talk to the data consolidators, they see it as well. You know what I mean? They see something needs to change in the market. All the organizations and all the panels I participated on talk about the price of market data and the contractual process and the audit process and the all these things, and companies have bubbled up that are focused on helping data consumers to better manage the contractual process and so forth and so on, right? But we're sort of, I think we're in an inflection in the market right now where, exactly as you say, Nikki, something needs to change. There needs to be a change in the way that we're doing things. And we're hoping from BCC Group that introducing technology that is neutral, much like what you said, Andy, right? Your technology is neutral, your technology is agnostic, right? That's what we do as a company. We deliver neutral technology that gives the customer the ability to, the data consumer the ability to pick their data providers more easily and not be locked into technology, locked into APIs and this kind of thing. Because we see this pain in the industry and we're trying to help solve it by introducing competition.
So short answer from each of you, have you had to compromise on a product as a result of the cost of market data? Andy?
Yeah, absolutely. We don't take a UK or EU feed at the moment. We only use US equities data for our platform because it was easier to get that data from SIBO in the US, and they were really flexible, really helpful. So have we compromised? Absolutely, we've had to compromise.
Karan?
I'd echo that. Yeah, 100%. We led with the US. We tend to go with the US equities, and I think for everyone sitting around listening to this, it like Nikki made a great point there, but it's like the value of this data matters now, but if the exchanges don't get to a critical size or lose critical size, then the value of the data they sell is also going to deteriorate. It's only so much squeeze can get out of this fruit before there's nothing left. And we've compromised a lot in terms of making certain, especially UK equities available to UK customers. It is cheaper for a UK customer to buy the US equity in the UK than it is to buy UK. And it's these things, these ticky-tacky fees and costs. We've made significant compromises in terms of doing real time. The US, again, easier to deal with. One of the things that you said there, I had an interesting thought. It'd be interesting to compare all the securities that are available on a US exchange and the per cost of security per data versus what you get in the UK. It's just like, I would imagine that ratio is off the charts.
Don't ask us to do that. We're exhausted from this study.
Yeah, no, but just like, even if you just take the, but just, it's a much bigger market, and I echo it again, Andy, what says, it's like dealing with the Americans so much more refreshing because they have competition, right? Like you deal with an upstart like IEX, you go, or Polygon, like the rate card's on the website.
Yeah.
How straightforward is that? And you talk to them, you explain what it is, the contracts are dealable. And I think for regulated businesses who are smaller, I think it's lost on data providers that we all forecast growth. That comes with costs, which then weigh down our reg cap. Again, it's just like the circle of life that goes. So it's a luxury to support UK equities. And then you have exchanges wondering why people don't want to list in the UK or Europe where there's no volume. Retail customers bring volume. And for you to tax them, which is effectively how I feel this is, then disincentivizes that, then there's less liquidity. And it's just a debt spiral. I can go on about others, like fractional equity is another example, right? You have people who the cost of equity sometimes might cost more than the transaction itself, right? Because you have to justify not just the cost of retail, but then the governance, which is, I think Bill mentioned that. I think the governance piece has to be really looked at. Like, can a firm of 20 people or 50 people deal with the governance costs put on by multiple exchanges in different languages? Like, is that a reasonable thing to expect? And this is not just a UK versus Europe thing, but if Europe, and I mean Europe, UK, Europe, wants to, build a viable capital markets that's competitive with the States, why would you take on the governance cost of 3 or 4 exchanges rather than just dealing with the States alone? It doesn't make sense. It's just not practical in any way.
Bill, how about you? Have you had to compromise products, and do you agree with those statements?
Not me personally, but our clients have had to. They're looking to be able to get their data from other sources other than what they're doing today, and they're struggling with that because moving from one data source to another is a lot of complexity and a lot of time. So definitely clients are looking to shop around more, and they would like to shop around more, and that they're hindered a bit by technology, but we're trying to address that. So.
And Andy, what would it mean to your clients if we just got rid of all of this contractual complexities and what I'm saying, getting rid of charging for costs of production?
Well, I think it goes to the heart of what you were saying earlier, Nikki, in one of your slides, that this situation is stifling innovation. What would it mean to our clients? Well, basically, we'd be able to get product out there faster. We'd be able to grow as a business, and we'd be able to bring some of the incredible advancements we're making in natural language generation through to the industry. And we don't fit to the natural product. I think what Karen was saying, what Bill said earlier, you know, the point we found on regular occasions talking to the exchanges, they do not understand our business. So they cannot understand that we consume all this data and that we then run our analytics over that data and produce natural language output that doesn't state their data. We use it as thematics, if you like, around what's moving in the industry, what momentum you've seen, what mean reversion has happened, and we make natural language statements on what has been going on. It could be aggregated, so we'll give an overall market color of what's happened. And the exchange said, well, our data's in there. It's well, no, it's not really. We've calculated our own technical analysis on the price of Apple or on Michelin or whatever. But ultimately, it's our analysis and our insights that we're producing from that data. And so we don't fit in a natural cookie cutter, which means our business could have been far further ahead had we found a reasonable partner for that data at the very early stage of the growth of the business. And we tripped up because of I have to say, natural inclination to go to the exchanges I knew and had worked within. And unfortunately, they just weren't able to satisfy our needs. And as we've just described, the ones that could, the Polygons, the Marketos, the Alpha Vantages of this world, those young, nimble firms that really understand the style and culture of what we're trying to deliver and understand AI, were able to actually ensure that we provided that. But they don't have all the data either. So we've got a sort of mix of data. Ultimately, to your point, or the answer to your point is, we could have been far further ahead than we are now had we been able to solve the data point very quickly, not spend what Karan said, 6 months. I mean, I've got email chains going back 6 months of people trying to recalibrate the costs of the data feed to us, send us test data which didn't work, send us a file format that just was erroneous to the thing that we'd asked for. Honestly, that combined just wasted a huge amount of time.
Okay, we're running a bit low on time, so just very, very briefly, Bill, anything you've got to say about if we remove this, what the difference would be for your customers and growth for the equity markets?
I think the clients are looking for a little bit more freedom, a little bit more transparency, as Karen mentioned, and I think that we need to help them get there. I think we think the pendulum has swung too far to the data provider and too far away from the data consumer, and I think we need to create a more level, equal playing field in this space. I think that'll help a lot, and then we talk a lot about that at BCC Group. This pendulum needs to swing back. So,
Karen, your views?
It's pretty simple. The outcome is that there'll be more retail clients who would access exchanges and want to have the opportunity to trade on exchange and access European securities. It's just like this notion that, oh, people in the UK have to trade in the UK. It's just not a thing. I think cannot think of a bigger red flag. There's a significant problem here when 3% of the revenue is coming from the equities. I don't think there's a certain element of short-termism, I think, that's happening at the exchanges that think about their interests ahead of national interests. And as a Brit, I think it's really concerning.
I completely agree with Karen's point about opportunity cost, Nikki.
Okay. So, gentlemen, thank you very much for really powerful comments from 3 entrepreneurs here who are all trying to do business in Europe. I'm going to move to questions. I don't know if any will be directed at you, gentlemen. If you have time to be here, fine. But if not, thank you for your participation. Jack?
We have a lot of questions, Nikki. I've so far had 35 questions through on the Q&A platform, so I apologise for in advance.
Okay, so let's hear what we can.
I think the first question, and we've had about 6 that are basically asking very similar things around the consolidated tape. We've got one from Terry Ung, Mark Shadell, and James Angel. I'll read the top one, which is, how will the European consolidated tape change the market, if anything? How does this pricing analytics compare to the US? And I'll also nod to this one here, which is that from James Angel, this is closely interrelated with the debate over consolidated tape. How should the tape be designed, and how much should exchanges be allowed to charge for their contribution to the tape?
Wow. Okay. So there's a lot in there, but basically, first of all, I would say we have consolidated data today in multiple different places. The only reason that it's not allowed to exist as a consolidated tape is all the contractual complexities and the costs related to the data. So putting a consolidated tape together would be solved if we could solve this cost and contractual issue. If we wait for the consolidated tape and say this is going to fix the problem, it isn't. That's like putting the cart before the horse, because if we solve this issue, as I said, we would already have consolidation. And the problem is, if we don't solve this issue, we've got this continuing vested interest where exchanges don't want the consolidated tape to really happen, or certainly don't want the best quality tape. We've already seen it in Europe. We've seen that the consolidated tape is not going to have attributed venues. There's this argument about how many levels of data it should be. The UK is not yet decided on some of these things. All of these arguments would go away, and we would have a better quality tape if we had resolved this issue around all these complex contractual fees and unnecessary costs that go with them. So I don't think we should be waiting and saying the consolidated tape is going to fix this. It definitely isn't. In fact, we could already be running a consolidated tape if this was fixed.
I mean, and on that question, I'll read a question from Mr. Mark Shadell, which was that, so we're all complaining about the lack of consolidated tape, which has been blocked by the same commercial interests represented on this call. I wonder whether you have any remarks on that, Nikki.
I assume that the question is related to the commercial interests being from the sell side or the buy side rather than from the exchanges. So I think the consolidated tape, as I said, already exists today if we didn't have all these contractual complexities. And therefore, I'm not really sure. I think, yes, there's lots of vested interests around all of this, but ultimately, if we didn't have all of these issues around contractual issues, we would be pretty much a long way along the line of having a consolidated tape. Yes, there are some issues around governance. There's some issues around quality of data in the OTC data. Yes, there's some vested interests in the OTC side of things, but generally, I think if we resolved some of this, everybody would be coming to the party and we would be starting to get a consolidated tape already.
Very good. We've had a load of questions through about fee structures, how the fee structures work. One person here who's anonymous said, do these types of fee structures exist in other industries, like Sky TV in the UK, charging more to a pub than an individual, Netflix limiting the number of profiles per account, regardless of the cost of production? How does this compare? Is it the same?
So look, yes, these, look, I'm not an expert on Sky and everything else, but I think anywhere where you have a organization where people either must buy it or that people are particularly beholden to one organization, whether they choose to. In things like TV, you don't have to buy Sky, but obviously if you do, then you're somewhat beholden to them. So it's a little bit different to having to buy market data. But basically in any market where you have someone who is basically offering a product that we have to buy, so it's probably more to do with things like energy, those sorts of things, then yeah, what you see is if without regulation, these institutions start to behave and impose fees that perhaps are not justified.
I suppose that leads to a question here from Pier Paolo Galli, who asked, wouldn't it be easier to tackle the cost issue from an intellectual property protection point of view? Until the data is protected by IP laws, vendors can apply whatever term and condition and fee they want for data usage.
Well, I particularly don't want to get into the conversation about who owns what data, because as I said at the very beginning, this is a mutual tool for growth of all of the market, and that's the way that data should be. If we start getting into the who owns what, I suggest that the market is not working effectively, because we never used to have these arguments when the market was working effectively. So You can go down the route of debating who owns what data, and I think that would be an interesting legal challenge. But frankly, I think you wouldn't need to have that discussion if the market was all working together to grow the equity market together. And the problem, as I said, is we've got this exchange business in a defense mode, and perhaps behaving in a way where it's asserting ownership rights over data that could be challenged, but actually in a market that was working very well wouldn't need to be challenged.
So this is quick fire question round for you, Nikki.
That's okay.
We've got one here on which has come up a few times. I'll read the top one. If market data costs reduce, is there a risk that the fees reappear elsewhere? How do you think that plays out?
So there is a possible risk. I think really market data fees and trading, we say that market data is a byproduct of trading, and therefore it should be in the trading fee. If exchanges have got the most fantastic trading platforms that do the best in price formation, then they should be able to charge more for it. If they haven't and they've got a homogenous product that everybody else is offering, then they won't be able to. So I think there's a point where, is there a value proposition that's better than somebody else's? Then maybe that justifies to be paid for. There's not many other places, if the recommendations that we've suggested, that the fees could go. They could go into the connectivity fees. Again, you know, there is more competitive tension in that, but it's a possibility they could go there. They could go into listing fees, because this is where everybody is saying the exchanges should get this extra revenue because they need it for listings, which, by the way, I think is a complete myth. But yes, look, it is possible, and we would need to keep an eye on that. It doesn't mean we shouldn't tackle the current issue that's in front of us, that basically is that these charges are based on cost of production that are completely unrelated to the exchange's own cost of production.
We've had quite a few questions about the Oxera report. I'll read the top one, Nikki, which is Oxera released a report last year which suggested regulated market data revenue had only increased by 3% annually since 2018. How does this align with Market Structure Partners' own analysis?
So, well, I think the market data disclosures given by the exchanges, which are the publicly available information, tell you everything. Oxera used some other private data, but the point is that trading volumes are going down while market data revenues are either going stable or going up. And frankly, if trading volumes are going down, then market data revenue should also be going down. So even if it's saying that they are stable or only growing by 3%, it's still counterintuitive to what is actually happening in the market and suggests there is a problem.
I've got another question here from Mark Shadell, asking, why does your analysis assume a correlation between market share and demand for data? Please explain the logic here that would cause this relationship.
Well, trading and data go together. So basically, there would be no trading if there wasn't data. Sorry, there would be no, well, yes, if there wouldn't be any data if there wasn't trading, and vice versa. So frankly, they are completely correlated. There isn't some separate value proposition being offered by the exchanges in a commercially separate market data stream. There might be if they were offering data analytics or value-added products, but they're not. So I think that answers the question.
We've got a question about the pandemic, the eternal question about the pandemic. Does COVID and the pandemic skew the analysis in any way? As we know, trading volumes peaked during the pandemic.
They did, but overall we've seen them going down, and we certainly didn't see market data go up and down in the same way. They only peaked for a very short period. And so, yeah, there has been some skew in the data. We have accounted for that if you read some of the notes in our report. But generally, I don't think it's a major issue in terms of our analysis.
Another question, is it surprising that all exchanges ended up charging the same segmentation of data categories?
Well, it's certainly interesting. I guess when one sees success being sort of created at one exchange, it's easy to follow suit and say, well, that was successful. Why don't we go down that path?
We've had a couple of questions about accuracy of data. Perhaps you might want to address that. We've had one here. The criticism isn't so much about the bias, but that there are conclusions drawn based on flawed data. Perhaps you want to comment on that, Nikki?
So I don't think the data is flawed. By the way, we've had very few comments from anybody. I've seen one exchange put a blog out. And apart from that, I think there's, as I said, we've had attention drawn to one figure in 2020, which was the exchange's own disclosure. By the way, we haven't had any other comments about the data being flawed or inaccurate. And so the greatest area of contention has been around the exchange's market data disclosure. I said in the presentation that everything we used had been a publicly disclosed figure by the exchanges themselves. There are some footnotes and details that we mentioned in this presentation where we will make a few changes, but none of it changes the overarching story that data revenues are going up while turnover is going down. The only other issues that have been raised are around these costs where we showed the 481% and the cost of the products going up or the non-display and display data going up. As I've said in the presentation, market data is based on multiple variables. It's much better if we don't have the argument on this level. We've used it because we need to show some examples of what's happening. But frankly, you could come up with 1,000 different examples, 1,000 different variables. There is no single cost for market data. And as we've heard from our entrepreneurs and we know from our own study, it's impossible to get a single cost and know what it is. So we could all end up having endless arguments on that basis.
There's a couple questions about regulators and competition policy. I'll try to sort of mash them together into one, which is that, really should any of this be a surprise to the regulators and the policy makers? Is this something that they should have been looking into for a long time? And do you think that this report will spur them into action?
So I think, to be fair to the regulators, this is incredibly complex. My team are financial market professionals. We've all worked in the industry for many years. And it's only when we get an opportunity to spend, like I said, almost 12 months studying something that you really see clearly. So, I mean, I knew there were issues with market data before, but I'd never really sat down and analyzed everything. So it takes resources. It's complex. There's a lot of complex issues being thrown in front of the regulators. Some of it very much is obfuscating the main arguments. I hope this report sheds light and makes it much more simple for them to look at. But as I said in the report as well, I think regulators could do a better job on looking at the disclosures, understanding what they mean, asking questions of the exchanges. I hope this report will spur them on to do that. And frankly, at this point, I hope the report now lays the ground for what is the basis of reasonable, because actually it's not that difficult now that we've explained all the difficult bits. When you actually get down to it, I think it's very easy to explain what is reasonable.
I think that leads to, there's a big collection of questions here around this exact question, but obviously the question of what comes next is pervasive here. And I suppose, are you saying that the data should be free?
So we're not making a sweeping statement to say that data should be free in some sort of random way. What we're saying is that exchanges should not be able to impose charges related to other people's cost of production. And actually, if you remove their ability to impose those sorts of fees, then maybe they could charge something like a once-off fee for connections and taking the data. But otherwise, it becomes obvious once you've removed those sorts of fees that exchange data is just a byproduct of exchange trading. And therefore, really, it becomes apparent that most data should be free. So we're not making it on a random statement. We're actually saying if you deduce it down to this amount or this level, that's exactly what should be happening. And then if exchanges want to add added value products like data analytics and other things that customers are willing to pay for, then that's different. That's a different type of market data fee. But yeah, I mean, basically at the end of it, the result is data pretty much should be free.
I've got quite a complicated question here. I'm going to read the whole thing out and you can respond to it how you will, Nikki. The exchanges play a major role in contributing to price formation and a reference price, which is then exploited by SIs, systematic internalizers, who are not subject to the same transparency requirements. The exchanges often argue that they should be rewarded through MD revenue for the role they play in price formation, which is unjustly used by SIs to drive trading away from lit exchanges. More a statement than a question, but I wonder if you want to comment.
Okay. Yeah. So I said at the beginning that data is a mutual tool for growth. And I think this type of talk about systematic internalizers using data for reference prices is really the exchanges being in defense mode because they're losing market share rather than being about the good of the entire market. I think SIs are clearly itching a scratch that the exchanges are not. People want to use them. But nonetheless, when we did our consolidated tape study in 2020, it was clear that less flow was going into lit markets because people couldn't see what was happening. And if we had consolidated market data, then more people would be sending stuff into a lit market. So the biggest blockers to that are really the consolidated tape, because people are actually worried about losing market data revenue, which is really a euphemism for, or price formation. The argument is really a euphemism for we're worried about losing market structure, market data revenue. So, exchanges in the proper world, we should be ensuring as much data is disseminated as possible and investing more in innovation, and stop worrying about systematic internalizers, because ultimately that flow has to make its way back into their markets as those SIs set up offset risk. So everybody is benefiting.
I've got a question here. I'm not sure if it's for us at Plato or for you, Nikki, but the report was funded by lobby groups. Aren't you just voicing their interest? Isn't this an example of regulatory capture? From Plato's side, I'll just reiterate what Mike said at the start of the call, which is that all of the research that Plato commissions is performed entirely independently. We only select the topics, and then the findings of that research are presented in their entirety to the marketplace. Sometimes that means that we don't like the findings of the research, and we find ourselves having to distribute findings that don't align with what our members want, but that's just a part of what we do at Plato Partnership. I'll hand it over to you, Nikki.
So, what I would say to that is no. You have just heard an incredibly powerful panel of entrepreneurs, none of whom are members of the lobby organizations, who are trying to set up businesses who can't set up those businesses, or certainly are compromising on products as a result of market data. So it became very quickly clear to us, yes, the intermediaries who funded this are definitely suffering in terms of prices. I think we've shown that, but there is a far greater impact on the whole ecosystem that is not working at the moment with the current way that we run market data.
I think we'll probably just ask one more question and let everyone get on with their days. But we've got one here. Doesn't price regulation undermine the competitiveness objectives of the CMU, and what's next?
Well, let's face it. What we have just set out is the fact that we never achieved full competition with MiFID I. We achieved competition in trading, but we never achieved competition in data. And in fact, we gave the incumbent exchanges a significant advantage, and we've just shown that's quantified at around 4 or 5 billion euros or pounds, ballpark. So we need to finish the job if we want competitiveness. This is not about protectionism at this point, which is what we've seen, but this is about finishing a job to ensure that we have a fully competitive and thriving, vibrant market. So I don't think this is about price regulation at all, but it clearly, if people have to buy data and we don't solve this issue, then yeah, we do need price regulation. It's the only way to move forward and to allow competition. I think the thing that people always forgot, and I saw it like a weighing scales back in 2007, is actually you have to fix the data issue along with the trading issue. If you don't fix one, you've got a market that's constantly out of kilter. I think that's something that regulators didn't understand, and now they do need to understand that. If you're going to force people to buy data, then yeah, you've either got to fix the behavior around the sale of that data, or actually you've got to price regulate for it.
Nikki, thank you very much. I think I've got a lot of questions here. I've got a big document where I put them all. I think we'll use those questions to answer in some blog posts and articles we'll be sharing in the coming weeks and months. But thank you, Nikki, for your presentation today. Thank you to all of our panelists. I think all I'll say is thank you to everyone for joining this call. It's such an important topic. We've had a huge number of people tune in today. In fact, we hit the limit on our webinar platform, so I think there are some people who wanted to come and couldn't come, but I will be sharing a video of this webinar with everybody who attended, and the wider marketplace. You will get a little poll afterwards, a survey asking how things went for you, so please do answer that survey if at all possible. But I think we'll just leave it at that. Thank you to our panelists, thank you to Nikki, thank you to our attendees, and we will see you on the next Plato webinar. Thank you.
Thank you very much.